This is Sandeep Anand. Welcome to Sand Compounding. I'm going to explain a concept of PE re-rating and PE de-rating, which has a significant influence on the way the stock prices move up or down. And this is the only factor which is market driven or perspective driven, and all others are, we know that it's driven by the earnings or fundamentals of the company. So let's get into the details of what PE re-rating means and what PE de-rating means and how it can influence the price of a stock. So what is PE re-rating? It's a perspective driven where investors are willing to pay a high price for shares in anticipation of high earnings or like a great management or a better operations or a change in fundamentals with regards to the future. A country itself can go through re-rating when it is in high growth stage, when its GDP is growing in all directions and it's going very high. Re-ratings are primarily based on the earnings potential or growth potential, which are future driven. Now, re-rating of shares can expand the PE multiple by a higher factor, which increases the price of the stock. For example, if the shares of company say XYZ are trading at $1,000 per share with earnings per share at $100, the PE is 10, right? It's 1000 by 100. Suppose a company is growing earnings consistently at 25 to 30% or expected to grow at 25 to 30% for next 3 to 4 years. The share price can drive up and drift towards based on the higher PE, say $3,000 in next couple of years, and the earnings per share goes up to 150. The new PE is 3000 by 150, which is 20. So which is double that of 10 in the previous period under consideration, right? So here the market is anticipating higher future earnings growth and can move up the price or push the price ahead, increasing the PE. And this is in anticipation, and this is called the re-rating in the market. So you see that the PE multiple goes up from 10 to 20 with an anticipation of earnings doubling or tripling in the next 3 to 4 years. So this is a powerful concept to understand. And similar, the straight reverse is PE de-rating. De-rating in the stocks, it's a perspective where investors are willing to pay a lower price in anticipation of a depressed earnings or degrading fundamentals of the company. Similarly, a country's outlook is dim or tepid, then it can go through de-rating based on the slower growth. De-rating of shares can compress the PE multiple to a lower factor. Compression happens. For example, let's take this. If shares of company XYZ are trading at $1,000 per share, the EPS being 100, PE is 10 currently. Now, suppose the company is expected to degrow earnings by say 25% or expected to degrow, for next 3 to 4 years at a pace of that, then the share price can go down significantly to say like 420 in the next couple of years. And this is with the anticipation that the earnings are going to be tepid, and the earnings per share also goes down as anticipated to 60. Now the PE goes down to 70, so the multiple has become 70 from will be 7, and the multiple has gone down from 10 to 7, which can really bring down the stock price, right? So it's an anticipation again of future earnings growth which are lower. So this is how the PE multiple re-rating and de-rating can influence the stock price. It's an important thing to understand. And once we get this concept of PE de-rating, re-rating, rest of the things are driven purely by the fundamentals of the company. So it's a concept that we all need to understand. Hope you found this informative.